Hi friends, welcome to this video where we will be studying one more concept on this module or on this concept of efficient market hypothesis. What is efficient market hypothesis? This theory given by Pharma states that if you are able to predict share prices just by looking at the charts without any further fundamental analysis or any of that sort, then the markets are considered to be inefficient, right? And if you are not able to predict the future share prices, then the markets will be considered to be efficient. Within efficient, there are three stages: weak form, semi-strong, and strong. The biggest differentiator between inefficient and efficient markets is the ability to predict the prices just by looking at the numbers, just by looking at the charts, basically, just by looking at the past trend. Trend analysis works. Then it is inefficient, otherwise, it is efficient. Now, we in the previous video saw how to judge whether a particular market is efficient or not using a concept called as the runs test. Everybody remembers that? Yes, we have done a detailed video, the previous one, runs test, right? Now in this video, I'm going to teach you one more test called as auto correlation test. Okay, it is called as auto correlation test. This test will also, just like runs test, help us understand whether the markets are displaying any sort of efficiency. And again, here also the test is for weak form of efficiency, but point is efficiency. In runs test, if you remember, the whole theory was that if the number of runs lie within an average range, then we will say that the market is displaying efficiency. But if it was beyond the range, beyond the upper limit, below the lower limit, then we say that the markets are inefficient. Everybody remembers this entire discussion. Similarly, here also, using the concept of correlation, we will be able to judge whether the markets are efficient or not. Now, how to do that, I'll explain to you through this question. This question has come in one latest ICAI CA final new syllabus SFM paper, and therefore it is very important for all of us to know how to solve using autocorrelation. I request all to first of all pause the video and read the question carefully. Start. Okay students, I hope you all have read the question. Let us now try to understand it. Okay, they are saying Mr. X is of the opinion that the market has recently shown the weak form of efficiency. Now, what is the meaning of efficiency? I'll again repeat. That means we are not able to simply judge the share prices just by looking at the trend. That means it's efficient market. In order to test the validity of his impression that the markets are efficient, he has collected the following data relating to the movement of the Sensex for the last 20 days. So they have given to you data for the last 20 days. Please note, we are not concerned with open, high or low. We are only concerned with the closing prices of the Sensex, right? These are the points given to you. Then they say you are required to test the weak form of market efficiency using auto correlation test taking a time lag of 10 days. Now, first of all, let us understand taking a time lag of 10 days means what? Children, taking a time lag of 10 days means first step is we have to bifurcate the entire data into data sets of 10 days, which means here if we have got 20 days data given, we will have two data sets, first 10 days and then next 10 days. That's how they have asked us to do it, right? So day 1 to day 10 will be one data set, day 11 to day 20 will be other data set. What to do with the data set, I'll explain now. But first point you understood, taking time lag of 10 days, right? We have to make two data sets of 10 days each. So let's make it and keep, and then I'll tell you what to do next. Okay, so I'll write down here step 1. Okay, step 1, I'll write down here day. Okay, I'll write down here day, then I'll write closing price. Okay, here also I'll write day and I'll write closing price. Okay, now here I would like to write first 10 days and here I would like to write next 10 days. right? So now let's put the numbers. Day 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and here I'll write 11, 12, 13, 14, 15, 16, 17, 18, 19, and 20, right? Let's put the numbers. So 453.99, so I'll write down here 33,453.99, 33 453.99. Then we have got 33 434.83, 33 434.83, correct? Then we have got 33 431.93. Like that, children, will just plot all the numbers, right, from day 1 to day 20. Okay friends, so what I have done is I have just plotted all the numbers here so that you don't waste your time. Okay, so these are the numbers, the closing prices for the past 20 days. Now what is step 2? Step 2 is to find the changes in prices. Okay, to find the changes, so I'll write here change. Okay, I'll write here change. Why we are doing it, I'll tell it to you in the next 5 minutes. First of all, let's plot the changes. So first of all, here, do you realize we will not be able to put anything, right? We will start from here. So now I'll write down here 33 434.83 minus 33 453.99, and that will come to minus 19.16. Understood? 33 434.83 minus 33 453.99, right? Let's then go to the next one. 33 431.93 minus 33 434.83, correct? Between these two, and that comes to negative 2.9, and so on. Like that, we have to fill the entire change column. I'll fill it up for you. So here I have plotted all the changes also for both the sets of 10 days. Of course, the first I have kept blank there because I will not be able to calculate this here since the previous data is not available. Yes, I would have been able to calculate this, but I am not taking it because I need similar sets of numbers on both sides, right? So now I'm keeping these two blank, and now let's discuss further. Now what am I doing here? I just took the previous 20-day observations, cut it into two parts, 10 days, first 10 days and next 10 days. And now I'm analyzing the share price movements, or basically the stock price, the stock market movements, right? Here are the Sensex for that matter, right? They have given to you here that they are analyzing the movement of Sensex. It's basically the share market points. So can you see that Sensex has been moving in each of these 10 days? Now I want to know whether is there any correlation in the prices, right? Or I might say in the changes in the prices between the two observation sets. For example, here in the first 10 days, can I say the Sensex went down by 19.6, then down by 2.9, then down by 48.52, like that it is going down? Corresponding in the next 10 days, what is happening? Oh, it has gone up by 34.36, then 43.39, then negative 45.11. I want to see whether is there any correlation between these two changes, okay? And when I will be finding out the correlation, children, what is correlation? It shows the strength of directional movements between two observations. Now, if the correlation is positive, let's say it is near +1. What is the meaning of that? The meaning of that is that if in the first 10 days the share prices are going up, that means I know that in the next 10 days also the share prices will be going up only, positively correlated. If the correlation, however, is negative, let's say near -1, they are going in opposite directions. What does that mean? That means if the share price in the first 10 days is going up, I know that in the next 10 days, corresponding days, it will go down. Negative correlation, right? So I'll again repeat. If the correlation between the changes of the two sets of observations is positive, what does positive mean? It means that if in the first 10 days the share prices are going up, the next 10 days also it will go up, or for that matter in the first 10 days the share prices, or basically the Sensex prices here, are going down. That means in the next 10 days also corresponding it will go down because the correlation is positive. They are moving in the same direction. And if the correlation is negative, what does that mean? That means they are moving in opposite directions, which means in the first 10 days, if the share prices are going up, corresponding the next 10 days, the prices will go down. Or for the first 10 days, if the prices are going down, the next 10 days, the prices will go up. Therefore, do you understand that if the correlation is near to perfect, like let's say near to +1 or -1, then do you have the brains to understand that just by looking at the first 10 days, I'll be able to predict what will happen in the next 10 days. If the share price change correlation between 2 days or between two sets of observations of 10 days is positive, then I know that if in the last 10 days the share prices have seen an upward trend, then in the next 10 days also it will be seeing an upward trend only. But if the correlation is negative, then I know that if in the last 10 days there has been an upward trend, then in the next 10 days there will be a downward trend, because I know that between 10 days sets of observations the correlation is negative. Right? So therefore, if the correlation is either extreme positive or extreme negative, do you realize it becomes very easy for us to predict what will happen in the coming few days just by looking at the past few days changes in the prices. And therefore, this is a classic case for a or for an inefficient market. You're understanding? For an inefficient market, I'm just looking at the trend and I'm predicting what will happen in the future because I am able to get a correlation between the different periods, right? Here I have calculated the correlation between two sets 10-day periods. So now if the two set 10-day periods are showing me a correlation positive, I now know that this share price or this stock price or this Sensex prices are having positive correlation, right? Positive correlation means they're moving in the same direction. So if I am able to see that in the last 10 days, the direction is upside, I know in the next 10 days, I can predict it will be upside. Or for that matter, if in the last 10 days it was downside, I can predict that in the next 10 days it will be downside because it is a positive correlation. And opposite for negative. Who wants to do fundamental analysis? Who wants to do insider trading? We don't want. Just by looking at the trends, I can figure out what will happen in the coming period if the correlation is either positive or negative. But do you understand that if the correlation between these two changes turns out to be zero, correct? If the correlation between these two changes turns out to be zero, what is the meaning of zero? The meaning of zero is I don't know what is the relation between these two sets, and therefore this I don't know situation means the markets are efficient. That means they are going on a random walk. That means I cannot do trend analysis and judge what will happen in the future. That means I cannot do chart analysis and say what will happen in the future. If the correlation is zero, I'm not able to figure out, I'm not able to predict what will happen in the coming 10 days just by looking at the past 10 days because the relationship is zero. Everyone clear? And that's what we have to do here. We will now calculate correlation coefficient. What we will do is we will consider this to be x and this to be y, and we will calculate rxy. If this rxy turns out to be zero, we will say that the markets are efficient. But if the rxy turns out to be near the positive or negative, then we will say, hey, we can do trend analysis and figure out, and therefore the markets will be considered inefficient. Everyone clear? Now some of you might be thinking, sir, exactly zero we'll get. No, but near to zero we should get, let's say somewhere like a range. If you remember the previous question, we gave a range for that average, right? Similarly, here the range could be plus 0.25 to minus 0.25. Correct? Now, if it's near that, we might say that yes, the markets are efficient. If it is going beyond, that means it's going towards a positivity or negativity, then we will say inefficient markets. Everyone clear? So let's now calculate RXY. So what I will do is I'll just write down here period. Okay. I'm not writing day here. So I'll write down 1, 2, 3, 4, 5, 6, 7, 8, and 9 because we've got 9 observations. So I'll take x. Now what is x here? Minus 19.16. So I'll write down here minus 19.16. Then there is minus 2.9. Okay, I'll write down here minus 2.9 and so on, and like that I'll write down y also. I'll just put the numbers. Okay students, so I've plotted all the data here. Let's now calculate Rxy. How do we calculate Rxy? What is the formula? It is covariance xy divided by sigma x into sigma y. I hope you remember that, right? So what is covariance xy formula? Summation of x minus x bar y minus y bar divided by n. So let's first of all find covariance xy. For that we will require x bar and y bar. So I'll take the calculator now. Minus 19.16, correct? Minus 2.9, minus 48.52, minus 12.48, correct? Minus 30.18, minus 9.77, plus 4.1, minus 33.11, minus 42.94. Okay, and this I'll divide by 9. I'll get negative 21.66 as the x bar here. For y, I'll do 34.36 plus 43.39 minus 45.11 plus 14.61 plus 26.6 plus 4.57 minus 10.28 minus 17.35 plus 17.29 divided by 9, and I'll get positive 7.56. Everybody clear? Let's now go to the next columns. The next column would be of course x minus x bar, that is 1, and y minus y bar, that is 2, and then we'll do 1 into 2. Covariance calculations you all know, right? So x minus x bar, minus 19.16 minus 21.66, that is plus 21.66, and that will give you 2.5 positive deviation, right? Then minus 2.9 plus 21.66, correct? Because minus plus, and this will become 18, okay, 0.76. Okay, this is 18.76. Then we have got minus 48.52 plus 21.66, and this is negative 26.86, correct? Then we have got minus 12.48 plus 21.66, and this is 9.18. Then minus 30.18 plus 21.66, this is negative 8.52. Then we have got minus 9.77 plus 21.66, this is 11.89. Then we have got 4.1, okay, 4.1 plus 21.66, this is 25.76. Then we have got minus 33.11 plus 21.66, and that will be negative 11.45. And then we have got minus 42.94 plus 21.66, and that comes to negative 21.28. Everyone clear? Let's now go to y minus y bar. So this will be 34.36, correct, minus 7.56, and that will come to 26.8. Next will be 43, okay, 0.39 minus 7.56, that will be 35.83. Next is minus 45.11 minus 7.56, that is minus 52.67. Next is 14.61 minus 7.56, that is 7.05. Everybody following? Next is 26.6 minus 7.56, that is 19.04. Next is 4.57 minus 7.56, that is negative 2.99. Next is minus 10.28 minus 7.56, that is negative 17.84. Next is minus 17.35 minus 7.56, that is negative 24.91. And then the last one is 17.29 minus 7.56, that is 9.73. Now children, we will do 1 into 2, correct? 1 into 2. So I'll just take the calci. 2.5 into 26.8. I'll press M plus. Then I'll do 18.76 into 35.83 M plus. Then 26.86 into 52.67 M plus. 9.18 into 7.05 M plus. 8.52 into 19.04 M minus 11.89. Okay, 11.89 into 2.99, again M minus 25.76 into 17.84 M minus 11.45 into 24.91 M plus, and 21.28 into 9.73 M minus MRC, and this comes to 1639.44. Okay, 1639.44. So we'll take it here, 1639.44, and we'll divide it by 9. Okay, we'll divide by 9 to find the covariance. So if I divide this by 9, I get 182.16, which I'll write it here, 182.16. Now what we need is sigma x and sigma y. Now as far as sigma x is concerned, it is under root summation x minus x bar the whole square divided by n. So for that we will have to do, so now for 1 square we'll do 2.5 into equal to m plus, 18.76 into equal to m plus, 26.86 into equal to m plus, 9.18 into equal to m plus, 8.52 into equal to m plus, 11.89 into equal to m plus, 25.76 into equal to m plus, 11.45 into equal to m plus, 21.28 into equal to m plus MRC, and this comes to 2625.4. Okay, 2625.4. So this is 2625.4 divided by 9 under root. So if I divide it by 9 and then I press the root sign, I get 17.08. Okay, I get 17.08, which I'll place it here, 17.08. Now let's go for sigma y. Children, sigma y will obviously be summation y minus y bar the whole square divided by n, right? For that we will have to do 2 square, correct? We'll do 2 square, y minus y bar the whole square. So let's start. So we have got 26.8 into equal to m plus, 35.83 into equal to m plus, 52.67 into equal to m plus, 7.05 into equal to m plus, 19.04 into equal to m plus, 2.99 into equal to m plus, 17.84 into equal to m plus, 24.91 into equal to m plus, 9.73 into equal to m plus MRC, and this comes to 6230.77. Okay, 6230.77. So therefore this will become 6230.77 divided by 9. So if I divide this by 9 and then I press the root, I get 26.31. Okay, I get 26.31, which I'll place here, 26.31. Let's now find the correlation coefficient. This will be 182.16 divided by 17.08 divided by 26.31, and this comes to 0.405. Now 0.405 therefore is the correlation between the two changes. Now this is not near 0, right? This is not near 0, it is quite away from 0, it is towards the positivity, and since it is towards the positivity means towards plus 1, do you realize since it is farther away from 0, not near the range of 0, do you realize that we will say that between the two sets of observations there is a good enough decent positive correlation. and therefore it will become easy for us to predict what will happen in future just by looking at the past one set of 10-day observations, and therefore such a market will be considered as inefficient and is not displaying the weak form of efficiency. Simple. Everybody clear? So this is what ICA has done. Of course, they have used a different technique on to calculate correlation coefficient, but we will follow the same technique which we have been following in the entire chapter. Answer is exactly same, 0.405. Everyone clear? So with that, we complete the discussion of this question. I hope you understood the concept of autocorrelation in order to judge whether there is efficiency or inefficiency in the market. Thank you very much for patient listening. I'll now flash the solution of this question on your screen, so you can pause the video and copy down the notes. Thank you so much. See you in the next video.